Welcome to Capital Economics. I am your host, Alex Koritis. Today we're going to look at some monetary measures. We talk about this a lot on the Capital News podcast, and like I've been informing my audience, I always like the audience who's listening to go and look at the data that I am describing. Don't just take my word for all of this. These are open sources. A lot of it's government data from the Federal Reserve, other governmental agencies, readily available to everybody. But what I'd like to do here today is take a look at some of those monetary measures that we talk about here on a weekly basis. Today, we're going to look at the Federal Reserve's balance sheet and M1 and M2 money stock. Now, we're going to have multiple presentations. I want to keep these brief. There's a lot of information contained within these charts and graphs. So let's get started with the Fed's balance sheet, which, of course, today actually hit a new all-time high, which is likely going to be the trend for the remainder of this year on a week-by-week basis. The Federal Reserve has committed, of course, they could change their mind, but they are committed to continuing with quantitative easing, QE policy, for the remainder of this year at a minimum of $120 billion per month. That's a big number. And most of that is going to be comprised of the Federal Reserve purchasing U.S. Treasuries and mortgage-backed securities. And of course, this has been an economic experiment that we have been going through since the great financial crisis of 2008 and 2009. We were, of course, told during that period of time that quantitative easing was an extreme measure, but we were in an extreme environment, so it was justified. We were also told that this was going to be a policy that was temporary, but as we all know, there is nothing more permanent than a temporary government policy. These policies have contributed and are the result of the largest wealth transfer in the history of the planet. And you can see it by these charts and graphs that I'm going to show here in this presentation. Some of them are going to be redundant, but simply pause the presentation, pause the video, and conduct your own analysis. Again, we're going to have multiple videos on this stuff, but I just want you to get a picture as to what is going on. When these people issue memos, press releases, when they give interviews, when they make statements on the mainstream media or those financial news stations, this is what is taking place. And it doesn't take an economist or a mathematician to know that something is not right, that our markets are broken. And I would argue that our markets have been broken for over a decade with the start of quantitative easing. Quantitative easing is basically the crutches that continues to prop up the markets. Take it away and the markets collapse. So no matter what you hear from a politician, it doesn't matter your political party or political philosophy, it doesn't matter who is on the Federal Reserve, doesn't matter who's managing any of the stock market exchanges. This is what is keeping stock market prices up, which we will show in subsequent presentations, and this is what is keeping the economy from utter collapse. And we can make a reasonable argument that many pockets around this country are enduring very tough economic times and have been for quite a while. This is all smoke and mirrors. So this is the Federal Reserve's balance sheet. This is the asset side of the ledger. This is primarily comprised of U.S. Treasuries and mortgage-backed securities. Of course, mortgage-backed securities came on to the scene. I mean, they've been around for a while, but with respect to the Federal Reserve's balance sheet during the great financial crisis, which, of course, was dealing with the real estate crisis at the time. So make no mistake about it. We are still dealing with the effects of the great financial crisis, which I always stress to my audience on the Capital News podcast. That's evidenced by quantitative easing, that they are still conducting these operations, that they are still purchasing mortgage-backed securities. And don't forget, folks, housing prices are at all-time highs. So why do they continue to support the real estate market if real estate prices have fully recovered and then some? Wonder why. An interesting question, isn't it? So what we're looking at here, again, the Federal Reserve's balance sheet, asset side of the ledger. Just for some historical context, of course, this data goes back to the inception of the Federal Reserve. founded in 1913, opened their doors in 1914, and it took nearly a century to get to $800 and some odd billion during the GFC. And then, of course, during that time, as we just previously noted, quantitative easing comes to the scene, and bam, presto, you see this huge vertical increase, a doubling of the Federal Reserve's balance sheet. That was supposed to come in, save the day. It was supposed to be temporary. This, in conjunction with some accounting changes, was really supposed to put a floor into the stock market and help to alleviate the broader economy as well. And of course, the stock market bottomed out in March of 2009, off the backs of quantitative easing and those accounting change rules. And then we've sort of been off to the races ever since, at least with respect to equities and other financial assets, which in and of itself was one of the reasons for implementing quantitative easing, to create a wealth effect, which we discussed many times before on the Capital News podcast. So you see this doubling back during the great financial crisis, supposed to be temporary. Markets continue to have hiccups. So QE1 is not enough. Have to do QE2, have to have Operation Twist. You get a taper tantrum where the markets throw a hissy fit because the Federal Reserve starts pulling some of the money away. They take the punch bowl away from the party. Markets don't like it. And then off to QE3 we go, and then we start to level off. So we started to level off during the Obama administration. That continued into the Trump administration. And then because the economy finally appeared to be looking a little bit better than what it had been. Appearances can be deceiving, folks. Well, the Federal Reserve said, well, this is supposed to be a temporary program, quantitative easing. We've been doing this now for several years. I think it's time to pull away the punch bowl because, if something happens in the economy, we already have interest rates at record lows or near record lows. We need to have some type of ammunition. We have to build up our arsenal again to fight off the recession. And what the Federal Reserve has done for quite some time in the event of a recession or a downturn within the economy is to cut interest rates. Well, when you're at or near 0%, there's not a lot of room to have any type of stimulus that is effective. So one of the first presentations that we did for Capital Economics was asking the question, are central banks trapped? We believe back in 2019, we made the argument and stated the case that that was the case. That is the fact of the matter. And ever since then, all we have is further confirmation of that argument. So you will recall, and we're going to get to this in some other slides, this is when the Federal Reserve was starting to taper. They were starting to come down from all-time highs on the Federal Reserve's balance sheet from $4.6 trillion, which is astonishing in and of itself, and they came back below the $4 trillion mark. And in the fourth quarter of 2018, we saw that big market sell-off, about 20% in the fourth quarter of 2018. All right, we'll talk about that later. But of course now, with the onset of COVID-19, the restrictions, the lockdowns, what have you, back to it we go. So the hissy fit and the panic of 2018 wasn't enough. Now you have the lockdowns, restrictions. Federal Reserve has to come in, so they believe, to save the day, to fill a void. You're going to lose a few $1 trillion in GDP, actual production, actual growth, actual investment. Oh, don't worry about it. We'll simply print the money and throw it into the system and we'll call it even. That's what this is. You thought QE1 was bad back in the great financial crisis. This is a near tripling. And we're not done yet, folks. This number, I argue, is likely going to hit the $10 trillion mark by the end of this year, and it very well may go higher. At a minimum, it's going to go about to $8.5 trillion, so another trillion from here. We hit an all-time high today, actually, with the updated figures at $7.55 trillion. That's a week-over-week increase of over $100 billion. So we are well on our way to the $8 trillion mark. Again, with $120 billion per month going in, with the Federal Reserve going in and buying U.S. Treasuries and mortgage-backed securities, we're at least going to be at $8.5 trillion by the end of this year. And I argue it'll be, again, at $10 trillion, maybe higher, because we're still talking about the $1.9 trillion spending bill. We're still talking about any type of legislation with respect to infrastructure, the Green New Deal or some variant thereof, and anything that the Democrats may try to push through with respect to healthcare. So we are far from out of the woods, but there is a lot here. And when I say vertical graphs, this is what I'm talking about. Okay? Doesn't get much steeper than that. So obviously some other things to look at is M1 money stock. And as you can see here, the same type of vertical growth. All right, we are nearing the $7 trillion mark with respect to M1 money stock. We're going to go through some of these other graphs a little bit more quickly, and we're also going to look at them on a year-over-year basis to see those percentage changes, which, of course, is crucial. So with respect to M2 money stock, same type of song and dance, record highs, over 19 trillion, nearing that $20 trillion mark, and with quantitative easing continuing, and with the Federal Reserve's balance sheet, M1 and M2 money stock almost moving lockstep with each other, we can expect all-time highs on a near-weekly basis as we make our way through the remainder of this year. So this, again, is just M1 and M2 money stock, but together. I'm going to move past this a little bit more quickly, but feel free to pause the presentation and take a look at any of these charts that you think are important. So here's the Fed's balance sheet once again on a year-over-year basis. Of course, going back to the GFC, you see this huge skyrocketing, nearly 160% change on a year-over-year basis. And then as it starts to make its way through the subsequent years, you can start to see the effects of QE2, Operation Twist, QE3, what have you. And this graph will come back and play at the end of the presentation, but this is something I want you to focus on too. This red line here is obviously the zero line on a year-over-year basis. And it had gone into negative territory. But look at when this started to go into negative territory. The fourth quarter of 2018, the same time that the stock market threw in a 20%, what they would call a bear market, within a very short period of time. So the argument that the economy and markets are strong, well, they're not. Because once you start pulling away the punch bowl, the party stops. And that's why you see this massive increase to the Fed's balance sheet, M1 money stock and M2 money stock. Because they're trapped. They know it, and there's not going to be any type of responsibility or accountability, so they're just going to say, well, we'll just keep doing what we're doing at a greater degree. Of course, this will eventually exhaust itself. When that happens, your guess is as good as mine, but it's not going to end well. That I can virtually guarantee you. That's the year-over-year change with respect to the Fed's balance sheet. So here we have, again, the Federal Reserve's balance sheet on the levels. So, of course, this white line here will signify what we looked at previously, that $7.5 trillion number, and that was just on the previous graph here at 80% where we currently stand right now. So you can just see how these obviously are moving together, which, of course, they would because it's the same data, just looking at it from a different perspective. So we also have the Federal Reserve's balance sheet against M1 money stock. Now, you'll notice over previous years, there's a bigger gap between the Fed's balance sheet and M1 money stock, but now you're seeing that they're moving much more closely in tandem. This, to me, is just a breaking point. This, to me, just further signifies the previous argument that the Federal Reserve and other central banks are trapped, because there will be subsequent presentations here that we look at other central banks as well. Predominantly, obviously, the Fed, again, we'll look at the ECB, the European Central Bank, the Bank of Japan, and possibly the People's Bank of China. We might throw another one in there as well, just to show you the level of currency creation that central banks and central authorities around the world have thrown into the system. This is not production. This is not growth. This is not investment. This is just liquidity being thrown into the system in their hopes and attempts to keep things afloat. Now, this is M1 money stock year over year. As you can see, this just blows all records out of the water. This is not even close. This data goes back to the 1970s, and year over year, this is at over 70%. Over 70%. I mean, 20% here back in the 1980s, close to 20% again back in the dot-com bust and the recession of 2000, 2001. Great financial crisis, 20%. We peak above it here a little bit. Subsequently thereafter, 21, 22%. And then off to the races we go. Now, it's highly unlikely that this rate of increase is going to persist for another year, but it's going to continue in the positive direction. Even all of these numbers above the zero line is positive. Even though there's a downtrend, the number was still going up year over year. So keep that in the back of your mind. And then with respect to M2 money stock, same story. Just an all-time high, this data going back to the 1980s. Not even close, over 25%. 1980s, you're about 13, 14% here. And then it's not even close anywhere else. These are the types of charts and graphs you see when you're looking at third world banana republics. These are not the charts and graphs you're supposed to be witnessing when you're talking about the United States of America, the largest economy on the planet. This is not what's supposed to be happening. This is more reminiscent. If I showed you these graphs and I said, well, this is Zimbabwe, this is Iran, this is Turkey, this is Venezuela, this is the hyperinflationary times of Argentina, you would say, yeah, sure. I said, nope, this is the United States of America. Not good. And then lastly, we have the Fed's balance sheet against M1 money stock on a year-over-year change basis. And this is the last slide of the presentation. But again, this is what I wanted to call out. Once we get to the zero bound here, if you want a year-over-year change, or we go negative, that's when the markets started to collapse. And I think from a historical standpoint, once all of this is past us, and I have no idea when that's going to be. I think it's going to be quite a while, to be perfectly honest with you. But once the financial market and economic historians come out, I think they are going to pinpoint this period in time as to when the markets were just bought and paid for by central bankers. That once that artificial stimulus was removed, there was no longer any type of support. That without the crutches, the markets could not stand. And this was still at near record all-time highs with respect to the Fed's balance sheet. So this was several $100 billion from peak to where it sort of bottomed out. And the world's largest economy and its subsequent stock market couldn't handle it. So something is greatly amiss. We know what it is. We know that this is all artificial. Money printing prints money. It doesn't print jobs. It doesn't print production. It doesn't print solvency. But it sure does keep a lot of weak companies alive. This is the economy of the living dead. Over 20% of U.S. corporations can be classified as zombies. That number is most likely getting worse, and that's a direct result of these policies. So with that in mind, that's the conclusion. Thank you for your time spending with us here at Capital Economics. Be sure to check us out on the podcast, The Capital News, thecapitalnews.com, and our YouTube channel also at The Capital News. I hope that was informative. We will have several more of those. We'll get a little bit more into the weeds, some of the details that comprise the Federal Reserve's balance sheet, and we'll look at these numbers as well against some broader stock market averages as well, just to sort of see that correlation between what central banks are doing and how the markets are responding. So I am Alex Kouraitis. Thank you for your time, and Godspeed.